Certainly much worse than I expected, much worse than everybody else expected. But we got to remember the Chinese economy is extremely weak right now. In December, it was probably in contraction. You saw that from the manufacturing.
Contraction. Outright contraction. So when we see these numbers of it's going to hit 6%, whether it's plus or minus 0.5%, last month it was actually declining.
Well, you look at the manufacturing PMIs, both of them, the official and the unofficial, were negative. You had bellwether car sales down 13%. You know, across the board, I think we're going to see a lot more. We got this Renmin University professor a couple of weeks ago, made a sensation across China. He said, look, the Chinese economy is growing at most 1.67%, maybe even in contraction. December looked like it was declining.
John, is this all because of the trade war with the U.S.?
You know, the trade war with the U.S. is causing a lot of damage for sure, but, you know, the global economy is slowing as well. U.S. is slowing, EU is slowing, U.K. is a total mess, Japan is slowing. So this is a very broad-based story. China, though, is very weak. Manufacturing is weak, as Gordon says. Service sector, which is much larger, less so, but still, it's slowing. And I've been actually, I like what I've seen lately in terms of the trade talks. I suspect both sides now are ready to actually try and sit down and announce something, whether they do something or not, so they have some kind of a victory to show, as we saw in the two communiques last week.
Gordon, do you think this latest economic data alters the balance of power in the negotiations? I guess the kind of dialogue, the rhetoric last quarter was that the U.S. market had sold off so much, maybe China had a better negotiating position. Is that flipped once again with this China data?
I don't think it's flipped because I think the U.S. has always had the overwhelming leverage. But you look at some of the new data, it certainly makes it more likely that we've got even more leverage than we thought. For instance, this trade data, you know, when you look at China's official numbers, 91.9%, China's merchandise trade surplus with the U.S. was 91.9% of its overall merchandise surplus. That's according to China's official numbers, which underplay U.S. exports, which means when we get our Commerce Department data, that 91.9% number probably going to go over 100. That shows overwhelming dependence on the U.S. market.
You know, we also got that surplus number out of China. Their annual surplus, $323 billion, was a big jump and the highest it's been since 2006. So does that enrage President Trump more? This is exactly what he campaigned against.
Yeah, it certainly doesn't help. But, you know, because we've got a more robust economy, we're going to be buying more stuff. So he had to expect that that was coming. But, you know, clearly, I think this shows that China really needs the U.S. So, on the other hand, it does strengthen President Trump's leverage in these crucial trade talks.
John, you mentioned the global slowdown, not just China, the likes of Europe as well. Do you think that is already priced in to U.S. stocks, given that, of course, the U.S. economy does remain more resilient?
The fact that I hold 70% cash says probably not. I don't think that's true. I think the weakness is yet to come. And I think that the UK story is not getting enough attention. You know, there's big events happening this week in London, and they're not good for the Brexit story, although they may end up with there not being a Brexit at the end of the day. But regarding the China, I don't really think it's so easy to decide who has what leverage, because you have to see through not only the numbers, but also the politics in both places to say that. The two things the U.S. is after, buy more of our stuff and change your entire operating system. The first one, they're getting wins on, of course. That's very easy. We'll buy more soybeans, we'll buy some more cars and so forth. But in terms of changing the structure, the industrial policy, the IP enforcement mechanism, those are like turning an aircraft carrier. They take a very long time. So I don't think you're going to see a rabbit out of a hat. But I do think Liu He coming here in a couple of weeks might give us an opportunity for them to declare some mini victories.
So, John, are you saying that the market has this wrong, that investors are too optimistic about the prospects of a deal?
I think we need to ask what a deal is. You know, when we're talking about changing IP law in China or the way they enforce it, you're talking about a massive enterprise that no one could pull off in a short period of time. They can say they'll do it, but that doesn't mean it's going to actually happen. In terms of actually purchases and tariffs and things like that, those are the easy ones because you can change them overnight. So I think that we will see net positive news on the trade war front over the next few weeks as both sides now are maybe figuring out that this is not something that's good for either one of us.